Do you guys know who Herbert Hoover was? Well, Herbert Hoover was the president that was in power between 1929 and 1933. More importantly, Herbert Hoover was, you could say, Trump version 1.0. Herbert Hoover was the first president to introduce tariffs to the United States of America, and he did so in 1930. Today, I want to look at whether we might be heading into a 1930 to 39 style recession, depression, a very deep recession or depression. I want to look at what were the factors that caused that to happen, and then I'm going to look at similarities to today. Finally, I'm going to look at what history has proven we can do to hedge our portfolios against deep recessions. And then at the end of the video, I'll also present an argument for why this may not come about. So I want to look at both sides as always, because we're analysts, we're not predicting machines. My name is Keith Richards. I'm President and Chief Portfolio Manager of ValueTrend Wealth Management, and this is the Smart Money, Dumb Money show. Let's get started. So this is a long one today, guys. We're going to start off just by talking about 1930, what happened then, and why it happened. So back in 1930, President Hoover was in power, as I mentioned at the beginning of the show. He passed an act called the Smoot-Hawley Act. And feel free to leave comments below as to what that stood for. I didn't research it. I just know that the act was called the Smoot-Hawley Act in 1930. This was just after the market began crashing in 1929. So he raised tariffs on over 20,000 of imported goods. Sound familiar? And this was done to shield American industries from foreign competition. And that's because the economy at that time was beginning to enter into what became the Great Depression. So in 1900, just to give you some history, this is 30 years before President Hoover introduced these tariffs, 4% of the US GDP came from global trade. By 1930, when President Hoover was in power, he came into power in 1929, but by 1930, when he introduced the Smoot-Hawley Act, 10% of GDP in the US was coming from global trade. So after the Smoot-Hawley Act was in place from 1930 to 29, guess what happened to global trade as a percentage of GDP in the US? Well, it fell back to 4%. So it wasn't necessarily such a great thing, obviously, for the US economy, because the US economy went through basically a 10-year depression. So obviously, the Tariff Act that President Hoover brought in was not as effective in accomplishing its goals of helping Americans and their economy as he thought it might be. So it's believed that the Smoot-Hawley Act was a big factor in increasing the length and severity of the Great Depression. So just to take a look at a chart of that period, you can see that times were good before 1929. Markets were going up. Here's the 1929 crash, and really that downdrift did not end until about 1932 or so. 1933 is right here. We started to see the market make a slight revival, but it never, well, I can't say it never, but it did not return to the original highs. This is the Dow Jones, which were near 400, even right to the end of 1939, which is here. So it was a very bleak period for the economy, and it wasn't all that great for the stock market if you were a buy and hold investor. So where are we now? Well, where we are now is that global trade now represents about 25%. It's actually around 27%, brand new information, but we'll use 25%. About 25% of US GDP. So I'm just going to draw a line here. So this is kind of the way from 1970 to around 2015 or so, the growth in U.S. trade was rapid. And around 2010 or so, 2015, we started to see it level off. And in fact, it's declined a bit. So actually, global trade is not as big as it was back in 2010, which is when it peaked, as a percentage of US GDP. Still, there's an awful lot of increased dollars since that period that resulting from global trade. So this is the scenario we are in right now. Now, the question is, if global trade starts to fall on this chart, for example, what will that do to the American economy and to the world economy? Well, let's take a look. So the question is, would tariffs reduce the USA's gross domestic product? Well, let's look at some figures. The US population right now sits at about 347 million people. The global population, the world's population, is about 8+ billion people. Well, cutting trade cuts will reduce access to a huge population, a much bigger population than the United States of America. When you reduce access to that very, very, very large population throughout the world, you reduce your potential customers, you could say, your consumers. So just as a fact, when we look at the stock market, because right now we're talking about GDP, which is gross domestic product, the economy. Well, how does that affect the stock market? Well, in 1980, 15% of the S&P 500's revenue was based on international markets, and by 24 it was 40% of the S&P's revenue. So it's significant. So it affects the economy, which in turn affects the markets. We know how the markets have grown with this wonderful world of global trade. As the IMF recently warned, if Trump's tariffs go through the way he is talking, it will hit the US prosperity and GDP very, very hard. So let me explain why tariffs can create recessions. Like why would that happen? Well, we just talked about the global market. So it obviously reduces the market. Well, also global tariffs can be inflationary, because if you confine the market to production only in the United States, well, obviously labor is more expensive, etc. So that creates an inflation. And also the tariffs when you import things, because the United States will also be tariffed on goods coming in plus going out. But when the goods come in from another country, they're tariffed. That increases the cost to consumers. So it's inflationary. It also tends to weaken the dollar. It weakens the US dollar, and that can also influence recession. So it also, they cut profit margins. Well, obviously, if the prices of products go up, the profit margins go down when consumption goes down, and perhaps countries have to reduce, or industry has to reduce their profitability because of those tariffs. Then in turn, you have lower profit margin, which creates layoffs. And that in turn results in recession. Well, speaking of the dollar, the US dollar, and how that's been affected, let's take a look at the US dollar. Now, I just did a video recently, and I was noting that I preferred the Japanese yen over the US dollar. But I showed you this exact chart, and I suggested that the US dollar seemed to be hitting support. Well, guess what just happened? It just broke support. So, really, where's the US dollar going next? Well, there's an awful lot of downside that I could see on the US dollar from here. So basically, we want to talk about protecting ourselves against a falling US dollar. Even as Canadians, it still impacts our investments if we hold US stocks. So let's take a look at that in a few minutes. But first, I want to talk a little bit more about the effect on the stock markets during recession. So on this chart, this is 100 years on the Dow. It goes back to about 1900. And you can see that most of the early 1900s were fairly flat. And it was the global trade actually that helped their economy, enhance their economy. It went from 4% of their GDP in the US to 10% at that time. And it really led into, leading into 1929, a really big boom on the stock market. Well, we know what happened. The stock market crashed, and the yellow line here is highlighting the recession. So we saw in the US a recession that lasted almost 10 years. So another interesting thing to see is that even though there was an eventual recovery, it didn't take out the old highs of 1929 for quite a while, but there was a pretty prolonged period of flat markets, and I want to point this out because there are periods in time where markets move into very sideways periods, and it's one of my arguments against buy and hold, by the way, is that you can go through 20 years, 15 years, 17 years where the market makes zero returns beyond dividends. So let's take a look at the next recession, which was actually in the early 1970s. It was based on an oil crisis. Now, there were several pullbacks during the 70s. There was also the Nixon fiasco, the Cuban Missile Crisis, all that kind of stuff. But the recession occurred, and I don't remember the exact years, but it was I think it was 1971 or something like that to 73. But you can correct me, comment below if you want to correct that for me. But I was around, I was a teenager in the 70s, and I do remember the price on gas and how hard it was to get a job during that period. So again, though, it resulted in another sideways market and a lot of downside on the market many times over during that 17-year period between, I think it was 65 to 82. So here we go. We saw another recession actually in the early 1990s, but the bigger one being 2001, 2002. And that was after the tech bubble and Tariffs Act, and that by itself created recessionary environment. And you saw what happened. The market went down. It tried making new highs, and it didn't last for long. In fact, we can call that a flat market because we saw another sell-off and recession led by the banking crisis and the subprime mortgage crisis and whatnot in 08. There was also an oil bubble in 08, by the way, leading into 08. But either way, you had another 13-year sideways period before the market took off. Well, here we are again, and we are, without question, entering into recession. The topic today is how deep will that recession be? How long will it be? I don't think there's much question we're entering into a recession. So that's why I put a yellow here. We're entering into recession, and let's continue to talk about what are the factors that might make it a deep one. Well, we're starting to see, talking about entering into a recession, we're starting to see some signs that CEOs that were just recently very bullish on the American economy are starting to pull back their expectations quite aggressively, actually. So this chart shows us the dark blue represents an increase. So this is the profit forecast by CEOs, chief executive officers, in companies in the S&P 500. And there was a very large percentage of them, around 70% of them were expecting their profits would go up in 2025. This was January, they made those projections. By March, it was almost 50-50 between people that thought that their profits would shrink, people that thought their profits would remain about the same, and then about 44% actually believed that their profits would shrink. We'll take a look at April. So right now, the most recent survey shows that they're actually quite bearish on the economy, with well over 50%, close to 60% of the respondents saying that things are going to be the same or worse. In fact, the biggest category is chief executive officers representing companies in the S&P 500 are bearish about their profitability going forward. And you guys, by the way, know why that is. So let's take a look at what that leads into. Well, when profits shrink, we just talked about it, that results in less hiring. So hiring forecasts by the same group of people, so this is the same surveys, January, March, and April, you can see everybody expected to hire lots of people. Now everybody expects not to hire many people at all. That, my friends, is called recession. Final thing to talk about, same survey, capital expenditures, also known as CapEx. And CapEx forecasts by these CEOs 12 months out from the various months, January, March, and April, have shrunk from being considerable, the expectations of making expenditures on materials, from buying stuff off of other companies, to 20-odd%. So very, very low number of CEOs expect to increase their CapEx spending. Their forecasts have shrunk in a big way. Let's say you buy into the argument that tariffs are going to be bearish for the economy, and not just temporarily bearish, but maybe longer term bearish. And obviously you hear where my bias is. I think that might be the case. But there's a caveat, and I'm going to go into that shortly. But what do you do to protect your portfolio? Well, I'm going to give you the easy answer first, because you already know it, and that's gold. So I've been in gold literally for a year and a half. I did reduce gold recently, but that was more for technical reason. But I'm still holding lots of gold, 11 or 12%. And it's a recession fighter. It doesn't always work. In the 90s, I mentioned early 1990s did have a recession, but and gold didn't make money that year, and the S&P lost money. But every other considerable recession, major recession that we've seen, gold during the negative portion of the S&P 500, in other words, the negative market action, gold went up. So keep that in mind. So next stop when we are looking for assets to hold during recession is we're going to look at stuff, because remember, we just noted that the US dollar just broke down. It just broke down. So, we hold stocks, and a lot of those stocks either are US stocks or are influenced by the US dollar. They sell to the US. It might be a company in Canada that sells to the US. It might be a company in Europe that sells to the US. Doesn't matter. So the US dollar isn't so great. So what this is showing us here, this is from Rosenberg research, is that there are certain assets that are non-correlated or negatively correlated. Now, what correlated means is that they move the same as the market or the dollar in this case, okay? So there are certain assets that have negative correlation. A perfect correlation is 1. In other words, 1-to-1 moves up or down. A perfect negative correlation is the market goes up 1%, this thing goes down 1%, precisely the same except the opposite direction. So when we see a number like this, so emerging markets equities, it's got a negative correlation of 0.59. It means that, well, if the market goes up, its correlation is often somewhat negative. It's about 0.59. It can go down about half if the market goes up, and vice versa. It's not an absolute relationship, it's a longer term relationship. So we want to pay attention to these factors when we think that the market is maybe less attractive on the dollar anyways. So you can see, what's less correlated to the dollar: equities, emerging markets equities, developed markets equities outside of the US, silver, etc. So these are things that we should be looking at. The final thing is sectors that we can hold, again, that aren't as negatively affected by the US dollar. Obviously materials, because that includes gold, but it also includes the base metals and whatnot, industrials. So you can see as you go down from there, though, like it's really in the 20s, and then it gets positively correlated after that. So you really want to stick, as I keep harping on people, to largely to commodities. So the final thing I want to talk about is maybe the upside, which is what could change this rather dire picture. Now, right now, the way tariffs are looking, the way Trump is talking, is that I would suggest that we are going to go into a prolonged recession. But things can change. And that's one of the things we have to be open to as analysts, as financial people. So if I go back to that book, and I've mentioned it a couple times on my videos, The Art of the Deal. Now, before everybody gets their buns in a tizzy, I know that Trump did not write the book. It's basically a series of interviews that were put together and edited, but it's basically a description of how Trump was doing real estate deals at the time. So let's not get caught up in the trees and forgetting to see the forest, okay? So the Art of the Deal talked about his strategy, which is to go heavy and hard-handed and nail into the opponent and just be outrageous, which is kind of what he's been doing. And then he backs off and he offers another deal that is still kind of bad, but not as bad. And that's just his style. So if that's the way he's going to do things this time, and we've seen some evidence to that, because he was talking 25% and then all of a sudden he started talking 10%. That was because of the bond market. I'm quite aware of that. The bond market was telling him in no uncertain times that you're pushing us into a recession, Mr. Trump. So he's aware of all that stuff. But whatever the case, there's a very high probability that all the scaremongering that he's been doing, it's going to be somewhat healed to a point. So the trade deals may end up lower, the tariffs may end up lower, and there's even a possibility, can't write this off, do not make flat assertions, that it might be favorable. And yes, I know I spelled favorable incorrectly here. So that's one of my trademarks, is I spell things wrong on almost every presentation. So the trade deals may end up actually being okay for the United States. I'm not saying there will be. I'm just saying that's a possibility. Okay, the tariff deals will on the positive side as well, one way or the other, will likely be wrapped up well before the end of the summer. Trump is pushing this, and he's pushing it hard, and it's going to happen. He's already sitting down with most of the leaders. He sat with Japan. Japan's been pushing back a bit. He's sitting with Europe, and he's just starting his talks with China. All of this stuff is happening now. It's going to be wrapped up soon. So we'll basically know the answer in no time. And the one thing I can tell you is a very long time trader in the stock market. I both traded professionally for 35 years, but I actually used to be, like many of you, I was trading on my own before then. So I've been involved with the markets for longer than maybe some viewers have been alive. And what I've seen is that the market hates uncertainty. If you notice that once we know the answer to, think of COVID just a few years ago, like it basically, that market ended and shot up pretty quickly once we kind of, okay, here's what's going on. So once we kind of know, the market hates fear. So when uncertainty becomes more certain, you'll probably see some change in the stock market to the positive. So that's another positive to keep in mind. So either way, if tariffs remain like they are, I would suggest that this recession will be elongated, and that means the stock market might not turn back before the end of the summer. So there's no predictions, but there's always a possibility that very well could happen. So I always like to say, and I'm going to circle this because I've said it many times on these videos and in my blogs and in my books and everywhere else, is that you don't make predictions, you just prepare. You don't predict, you do prepare. So I hope this puts some thoughts into your mind as to how you might be able to prepare for a potential long-term recession, what you can do for it, and what the probabilities of it happening are. Thanks for watching, and we'll see you next time. Hey, thanks for watching. I hope you got value out of this episode. Please like and subscribe below. We're trying to grow the channel, and it would really be doing us a big favor. I'm presenting ideas every week on trades that we're actually looking at ValueTrend. And by the way, I don't just talk the talk. I walk the walk. I have been a portfolio manager for 35 years. And in fact, I was one of the very early pioneers in technical analysis here in Canada. On my website, valuetrend.ca, you will see a link for our online trading course. And this course is a complete money management system. I do encourage you to take a good look at that and consider taking it. I priced it extremely low because I want retail investors, that's you, to take the course and get value out of it. It's literally my 30 plus years of experience put into one complete step-by-step course. And honestly, I wish that I had had something like this when I was an early investor. It really will stop you from making so many mistakes. I also suggest you subscribe to our Never Miss an Opportunity program, which is our blog and our newsletter. There, you're going to get ongoing ideas, tons of charts, lots of trading ideas. And by the way, we never, ever solicit. We don't send you junk spam and stuff like that to try to get your business. It's for information, because part of my passion is to teach retail investors how to invest properly. I've been doing this, as I said, for 35 years, and I hope that I'm able to pass on some of the things that I've learned through this career as both a pioneer in technical analysis in Canada and a longtime portfolio manager. Thanks for watching. Don't forget, push like, push subscribe. See you next time.